Hi everyone, so we're going to continue with our adjustments to consolidated statement of financial position, also known as the consolidated balance sheet. And as I said before, most adjustments are intercompany transactions, and one of the intercompany transactions you can have is where there's is a sale of PPE. So let's consider an example where we've sold PPE between two entities in the same group. And the initial cost of 300k, the sales price was 700k, and the carrying amount of the PPE at the date of disposal was 250k. And for ease, I've said that the disposal happened at the beginning of the year. Okay, let's see what's happening at the year end. So as a result of the sale, we're making cash of 700k in entity 1. I'm assuming that the sale was done with cash immediately paid. For entity 2, we're seeing a cash decrease of 700k, so the net impact is nil on the group. What else is happening? Well, we're getting rid of PPE of 250k, so we're seeing a reduction by the carrying amount. Entity 2, we recognize the PPE at its original cost, at its initial cost, and the initial cost was 700k. So we're seeing an increase in PPE of 700k. So what's the net impact on the group? Basically, 700 minus 250 gives us 450. So we're seeing an increase in PPE by 450k. What's the other impact? Well, we're also making a profit in entity 1. The profit is the same as the sales price, 700k, minus the 250. So we're seeing a profit of 450k, but there's no movement on the other side. So our profit is increased by 450. And if we hadn't sold the PPE, we would have a depreciation charge of 30k, because 10% of 300k, which is the initial cost, would give us 30. But because we did sell it, we're incurring a higher depreciation charge because our cost is now 700k. We're depreciating that over 10%, so our depreciation charge is 70k. And if our depreciation charge is higher, our total expenses are higher by 40k. So our profit is lower by 40k, and our PPE is lower by 40k if we're incurring a higher depreciation charge. Now let's consider the impact of all of these adjustments. So there are two that are going to PPE, and there are two that are going to profit. Let's look at PPE. So increase of PPE 450, decrease of PPE by 40. What's the net impact of that? What's 450 minus 40? 410. So our group PPE is overstated by 410k. What about the profit figures? So similarly, we're increasing profit by 450, we're decreasing it by 40, so our profits are overstated by 410k. And a 410k represents the overstatement in the carrying amount of the PPE. So we need to correct for these, and it's quite simple because both of them are overstated by the same amount. So you correct it by reducing PPE by 410k. You credit retained earnings by reducing by 410k, and you can also reduce profit by 410k. And think of profit and retained earnings as the same figure. So the overall entries are, if we're reducing PPE, we're crediting PPE, and we need to debit retained earnings of the seller by 410k. Now, how can we calculate this in an exam question? What's the easiest way of doing it? Okay, so we should have our initial carrying amounts. So we have our should be and our actual column. So our initial carrying amount is 250. If the sale hadn't happened, we would have incurred depreciation of 30k, and this would have given 220k. Our actual, what we actually did, our initial carrying amount was now 700k, less depreciation of 70k gives us 630k. So our difference is 410k. And as we said before, we would debit retained earnings of the seller, 410, and credit PPE by 410. Now let's look at a question where this time we're selling inventory within the group. So entity 1 sells 150k of inventory for 200k to entity 2. So the overall profit figure is 50k. Let's see what's happening. So again, we record the transaction. I've summarized it here. So we're making sales of 200k on one side, but on the other we have a cost of sale of 200k. So one man's income is another man's expense. So we're getting a nil impact on profits for group. What about inventory? Well, inventory, we're getting rid of a inventory of 150k. On entity 2, we're actually acquiring inventory at 200k because we're buying it at a cost of 200k. So the overall impact is an overstatement of inventory by 50k. Now the other impact is entity 1 is also recognizing a profit. It's making a profit of 50k from an intragroup sale, and that doesn't make sense at group level, because remember, we don't care what's happening on the inside for a group, we care about what's happening on the outside. So we're actually making a overstatement of profit of 50k. Right, so the inventory and the profit figure are overstated by the amount of profit that's been made. Okay, so if we're overstating inventory, to correct for it we need to reduce inventory by 50k. The overstatement in profit, we have to correct for it by reducing retained earnings of the seller, or getting rid of reducing the profit on the sale. So we do debit retained earnings of the seller, 50k, and credit inventory, 50k. Now, let's consider another situation. Entity 1 has done the same sale to Entity 2. This time Entity 2 has sold all of the inventory outside of the group for 500k. Okay, now let's think about what figures we're going to expect at the group level. What's the net impact going to be? Well, we're making sales of 500k and we're losing inventory of 150k. So that means that we're making a profit of 500k minus 150k, and that gives us 350k. Okay, so as we said, profit we expect to make is going to be the 500k minus 150, and that gives us 350. We're expecting a reduction in inventory of 150k, and let's see what actually happens. So it's a bit of an experiment basically. So before we made the sale to the external party, our inventory was overstated by 50k and our retained earnings were overstated by 50k. Now after we sold to the external party, we got rid of, as a result of the sale, we got rid of 200k worth of inventory, because in Entity 2 the cost of the inventory was 200k. We actually made, when we sold to the external party, Entity 2 made a profit of 500k minus 200k. So its profit was increased by 300k. So what's the net effect? Well, 50k minus 200 gives us minus 150. So there was an inventory reduction of 150. Increase in profits of 50 plus increase in profits of 300 gives us an increase in profits of 350. So both figures match the net effect. So we don't require an adjustment when we sell outside the group, because we're realizing that profit. We're realizing a profit when we sell outside of the group. So if all inventory is sold outside of the group, we don't have a consolidation adjustment, because we're making a profit, a group profit, by selling outside of the group. And that group profit is actually real. It's a realized profit, we say. Now let's consider an example where we don't sell all of the inventory outside of the group, we only sell 10% of the inventory. Okay, so again, let's see what we expect. So we're getting rid of 10% of 150k of inventory, and that's 15k of inventory, and we're selling that for 500k. Okay, I know that's a bit cheeky, but I'm just using it to explain a point. So as I said, our inventory is going to be reduced by 15k, and our profit is going to be the same as the 500k minus the 15, and that's going to give us 485k of profit. But let's see what we actually get. Okay, so let's work through this table step by step. So before the sale, we had an overstatement of inventory by 50 and an overstatement of profits by 50. After the sale, okay, so 200k of inventory was in entity 2. We got rid of 10% of that, so our inventory was reduced by 20k. Similarly, we made a profit, and our actual profit that we've recorded in entity 2 is 500k minus that 20k, and that gives us 480. So what's the net effect? Well, the net effect is an increase in inventory of 30k because it's 50k minus 20. Similarly, before we sold, our profits had increased by 50k. Now the profits have increased further by 480, so we've got an increase of profits by 530. And as you can see, we expected inventory to only reduce by 15, but we've actually got an increase in inventory. Similarly, we expected profits to increase by 530, but they've only increased by, no, we expected profits to increase by 485, but they've actually increased further. So this time our overstatement is 45k and 45k. So we started off with an overstatement of 50, and that's marginally reduced to 45k. Okay, I suggest working through this part yourself if you don't understand. So we need to make an adjustment to correct for these figures, this overstatement. Now, here's another way of thinking about it. So before we sold to the party, external party, our overstatement was 50k, but after the sale, our overstatement was only 45k, which is the same as 90% or 50k. And the 90% is the amount of is the percentage of inventory we're holding at the year end. Okay? So if inventory is not sold outside of the group, we need an adjustment called a provision for unrealized profits. Okay? We say the profits are unrealized because we're not selling them outside of the group. We haven't made a profit because we have a group profit because we haven't sold outside of the group. And this is called a provision of unrealized profits, or a PURP. And PURP is equal to the percentage of inventory remaining in inventory at the year end multiplied by the profit on the intergroup sale. So our percentage of inventory remaining at the year end was 90% because it was 100% minus 10%, and our profit figure was 50k, so our PURP adjustment is 45k. And we're going to explain, we're going to just run through all the adjustments we've posted so far. So here we have it's an elimination of intercompany balances. We did debit creditors, credit debtors of this much. For adjustment 2, it's you're debiting retained earnings of the parent and crediting goodwill. Now let's look fair value, as we said, adjust net assets at acquisition, net assets at year end. Now for intercompany sales, we always debit retained earnings of the seller. So all for even inventory, we're debiting retained earnings of the seller always. Okay, and we're crediting we're crediting the account that's the type of item that's being sold. So if it's PPE, you credit PPE. If it's inventory, you credit inventory. Okay, and the intergroup sale of inventory we call a PURP adjustment, PURP, which is called provision for unrealized profits, PURP. And this figure is given by the profit on the sale multiplied by the percentage of inventory remaining. Okay, so remember we did debit retained earnings of the seller, credit inventory. Now you can also have a PURP adjustment where you're selling, where the group is selling to an associate, and that's leading to an overstatement of profits or a misstatement of profits. Where the group is selling to an associate, you debit retained earnings of the seller. Now actually let's deal with adjustment 8 first. So if the associate is selling to the group, I'll just put PURP because it's the same. You credit inventory. You always put the credit to inventory. Okay? Where possible, always put the credit to inventory. And share of profits is the same as retained earnings, okay? Of parent. Of buyer. So remember, no, associate, no, retained earnings of parent. I've written it badly. So if associate sells to the group, we credit inventory and debit retained earnings of the parent. If the group is selling to the associate, we credit investment in that associate first, and we debit retained earnings of the seller. Okay, whoever it is. And the only difference with 7 and 8 is that the size of the adjustment is based on percentage ownership. Okay, times by percentage ownership, which we'll cover later on. Just another point about PPE is that the adjustment that you make is the difference in the expected carrying amount and the actual carrying amount. Now let me just cover PURP in relation to associates. So as I said before, the amount is the percentage ownership times by the profit on the sale of the inventory times by the percentage of inventory remaining at the year end. So it's the same formula, but we need to factor in the percentage ownership. So if I just change my arrow to arrow options and then automatic. Now consider this example. Parent has 30% ownership of the associate. Associate sells goods to the parent for a profit figure of 300k, and 50% of these goods are remaining at the year end. So let me just clarify. A is selling to the parent. What is happening? So if I just go to my options and I go to automatic, let's see what's happening. So there's an unrealized provision for unrealized profit if we use our formula. So 30% times by the profit of 300k times by percentage of goods remaining at the year end, 50k percent, gives us 45k. So the associate is making the profit and 45k is included within the profit. So we reduce the share of profit of associates by 45k. So remember this is debited to investment in associate. We reduce it by 45k, and we therefore reduce the retained earnings of the parent by 45k. So debit retained earnings of parent 45k. But it's the parent who's holding the inventory. So you credit group inventory by 45k because that inventory is included on the consolidated balance sheet. Now, the only other potential other transaction that can happen is where the same transaction, except the parent is selling to the associate. Okay, and the inventory is held at the associate on the associate's books. So again, we're making a provision. The provision for unrealized profit, or PURP, is 45k. And that's the adjustment we need to make. The parent is making the profit this time, and the 45k is included within the profit incorrectly, so we need to reverse that out because it's like an intergroup transaction. And the 45, yeah, it's like an intragroup transaction because that 45k of additional of profit in the parent is being reflected as an expense in the investment in associate. So the way we correct for this is we increase cost of sales of the parent by 45k, and we debit retained earnings of the parent by 45k. Now the associate holds the inventory, but we don't see the inventory at group level because we don't add the assets and liabilities together. Okay, we don't add the assets and liabilities together. The only item on the balance sheet that relates to associate is the investment in associate. So we just credit to investment in associate of 45k. Right, so these are the only adjustments we make. So that's it, guys. I hope that was helpful, and please keep in touch and let me know if you have any questions.